Hello everyone and welcome to our webinar. It's been a while since our last webinar. The trade has been somewhat sporadic in September, October with the Jewish holidays and Diwali and various other things. So we missed our regular timing, but it's good to be back, and it's such an interesting time for the trade right now. So I'm looking forward to sharing some insights as to what we're seeing in the market. And maybe what we can expect in the months to come. It's not an easy market to navigate and to assess, but we're certainly going to try. With me in the room is David Ehrlich, who's handling the technical side of things. So thank you to David. And a lot of what I speak about today has been developed through my conversations with Shimon Gerstensang, who is head of the pricing division, and we have some really interesting conversations that helps formulate my understanding of the market. So thanks to Shimon for his help with that. Just to run through what we want to achieve with the webinar, the headline for the webinar was expectations for the holiday season. But really, when I speak to people in the trade, the question on everyone's mind is what's going to happen in the first quarter of next year? What's going to happen after the holiday season? Of course, much depends on how jewelry sales go in November, December. But we are seeing an improvement in the trading environment since late October, November, and the question on everyone's mind is that if that's enough to sustain the market through the first quarter of 2020 and ensure that next year is a better year than the tough one that we endured this year. So we're going to try and tackle that question rather than the question of the holiday season, and in doing so, we're going to present a snapshot of what we see in the market in terms of supply primarily, because that's been the big question that's influenced the market for much of the year on the downside. And then we'll take a look at some of the demand trends and of course the pricing, which we usually do. We're going to touch on some interesting developments in the trading environment that has resulted as or is a consequence or a cause of the current market environment, and then we will touch on how the retail sector is looking at this time of year. So before we get to that, we want to ask your opinion, looking ahead at 2020. What is the potential scenario that you believe will most affect the diamond market in 2020? And if you could, I'm going to give you 5 options shortly, and if you could voice your opinion or your vote as to which you think is the most likely to affect the market. There's a poll section in your in the Zoom application that you're watching the webinar. So the first option would be a continuation of the excess supply that we've experienced for much of this year. Do you expect a slowdown in the US economy to impact the market? It's a scenario that some people are painting. Do you expect economic growth in the US, which would spur an improvement in diamond trading? Our fourth option would be the impact of the US-China trade war. If that will have a continued impact on the market. And then finally, that tight manufacturing liquidity would continue due to a further reduction in bank financing, which again has been a strong theme in the market in 2019. So we're going to revisit that question. We're going to revisit that question later in the webinar, and I look forward to hearing what you have to say. So let's take a look at the market. We're in the middle of the fourth quarter now, from the beginning of October, we've seen some stabilization of diamond prices as per our RAPI index. That after a tough year in 2019, there's no two ways about it, that it was a tough market, and we saw that that play out in diamond prices in the RAPI index, which dropped in the first 9 months of the year. Since October, we've seen some stabilization in the RAPI index for 1 carat, and so far as of yesterday, there's a 0.1% increase in that in the index. I'm going to focus quite a bit today on the 30 pointers, because that's where we're really seeing an interesting improvement in the market since well, over the last month or so. And we're seeing that again in the RAPI index. The 30 pointers have really come down steeply since the middle of 2018. But now we're seeing some firming of diamond prices in this category, with the RAPI index for 30 pointers up 1.8% since the beginning of October. When we look at all categories since the beginning of October, it's the same theme, that generally the market seems more stable and firm over the last month, with the half carat is up 0.4% and a bit more volatility in the 3 carat of the RAPI index, down 0.3% so far in the quarter. But to put it in context, it's a welcome relief from the steep declines that we've seen until now, and the RAPI index for 1 carat is still down 4.5% for the year to date. This graph is showing from January 1st to yesterday. The 30 pointers has dropped by 13.4%, the half carat is by 7.7%, and the 3 carat is by 16.2%. So in the greater scheme of things, when we're looking at the year as a whole, this is really the picture. But when we're looking at the improvement in the market environment in the last month, we can take some encouragement from that. And we want to explore a bit what's influencing that improvement. So we all know, and we've been talking a lot about the decline in diamond manufacturing, that with the overhang of inventory that we've spoken so much about in previous webinars, manufacturers have limited their polished production, and we're seeing that primarily out of India being the largest of the manufacturing centers, accounting for an estimated 90% of global rough manufacturing by volume. And we're seeing that that in the 9 months to date, from January to September, compared to the same period last year, the value of rough imports to India is down by 23%, and by volume it's down by 14%. So we've seen that significant drop in polished output, in manufacturing activity, and that's and we see a similar trend in India's exports of polished, that all that rough is translated into polished and sent primarily for export, and polished exports are down by about 15% in the first 9 months of the year. So there has been a concerted effort in the trade to reduce that excess inventory that we've seen for much of 2019. So we want to see if that's played out on RapNet. And when we look at the total volume of diamonds on RapNet, that includes all categories of round, fancies, and all qualities. We have seen a decline in the volume of stones. It's been fairly stable over the last 2 months, but certainly from August, there's been a slight decline compared to this time last year. It's down by about 8%. But then historically speaking, compared to 2 years ago, it's slightly up, and it's quite significantly up compared to November 2016. So I would say that still, historically speaking, there seems to be a higher than normal volume of diamonds that are on the market. So where has the decline in manufacturing taken effect, essentially? And so when we look at the main part of the market today, we look at RAP spec A3 and better diamonds, Rapaport specifications of A3 and better diamonds, and that's essentially XXX and XXX goods, no fluorescence, and including faint fluorescent, no BGM, etc. So it's the better quality diamonds that are on the market. And just before I get to the next slide, just to give you a bit of an update on what we're working on at Rapaport, is that we're working on a redesign of diamonds.net. And part of that redesign is going to include a business intelligence tool, a BI tool, that will give our subscribers to the Rapaport research report access to an interactive data, pricing data and market data from RapNet. So I'm going to give you a bit of a glimpse into that BI tool with the next few slides, and God willing, that tool will be made, or our redesign of diamonds.net will be launched in the coming months. So if you just bear with me for 1 second. So when we look at inventory of RAP spec A3 and better goods, which is what the BI tool is presenting, and it's also what we present in the data of the Rapaport research report. We see that the drop in inventory has been much more significant. That year on year it's down about 46%. But if you look at the top graph in November, that compared to June, July, August, there's been a significant decline in these goods, and this is showing inventory across all countries. Across all countries, we can select specific countries. So, for example, internet depending, this would show the inventory in India, but it's all inventory that I'm interested in at the moment of 30 pointers. D to G color and IF to VS2 clarity goods, and so we see a drop in inventory in that category, significant drop in inventory. When we look at and part of that drop in inventory must surely be the reduction in manufacturing that's taken effect, but on the other side of things, it could also be an increase in demand for those goods, and so. This slide of the BI tool presents the sales data that we present also in the Rapaport research report, where we're able to assess the level of sales of inventory that is sold through RapNet with a slight lag in our analysis. We have to give the stones some time to go through the system, and so this is showing our sales. The bottom graph is showing our sales of that same category of 30 pointers, D to G, IF to VS2 in September, and we're seeing a slight increase over the last few months. Probably the most interesting graph would be this top right-hand corner graph, which shows that the percentage of sales out of available inventory. So what percentage of goods on RapNet are selling through and during the month, and so we've seen a sharp increase in this category. That today we have about 45% of goods sold compared to the low 30s and 20s where we were a few months ago or earlier in the year. This graph you'll all be familiar with from the research report, that for that same category, the rate of sales, the time it takes for new inventory that's listed on RapNet to sell through has increased quite dramatically over the last few months. That it's taking much quicker for goods to turn over in the market. So in September, and you can ignore this last bar, it's not entirely up to date, but in September, 68% of new inventory was sold within the first month, whereas in May and June, it was around 45%, which marks a significant change in the market. I'm just going to quickly run you through some of the other categories. There's a similar trend that we see in the 50 pointers, that inventory has, sorry, it's the internet is taking its time. Sorry, so the 50 pointers is showing a similar trend, although slightly less dramatic as the 30 pointers, and so there has been a decline in inventory. And we're seeing, in terms of the sales of 50 pointers, a similar increase in the percentage of goods that are sold, and an increase in the actual sales on RapNet. When we look at the 1 caraters, which is as expected, it's a much more stable market in terms of the inventory movement, and also in terms of the sales. That there's much more stability in the market. So really, what's emerged as quite interesting for us is the improvement of the 30s, 40s, and 50 pointers that we've seen in the last month, and that supply and demand story tells a bit of gives us a bit of insight into why, or what's influencing prices to stabilize in the last month. Interestingly, we've stressed in the past, when the market was when these categories were declining, that it's very much particularly the 30 pointers are very much a Chinese item. It's an item that's popular in the Chinese market, and the Chinese market is what influences price movements in these goods. And so the slowdown in China had an influence on the decline in pricing of 30 pointers. And so the question is that what's happening now that the market has, now that we're seeing an improvement in these goods? And that's something that we need to look into a bit deeper. If the improvement in 30 pointers is as a result of improved Chinese demand, which we need to speak a bit more to the market about that. It's not quite clear. What is maybe clear is that dealers are seeing a buying opportunity here, that that prices have come down to such an extent that that maybe they're seeing the market has bottomed, and that there is a buying opportunity in these goods. But it does require some more analysis on the demand side. So when we look at the total volume of inventory on RapNet, and then we look at the volume of RapSpec A3 and better goods, that inventory has come down by a lot more, and the sales seem to be much stronger of the better quality goods, those RapSpec A3 goods, than the total market picture is showing. It leads us to the conclusion that that there's a segmentation in the market that's happening, and sorry. the diamond market is segmented into various categories, and that also leads us to the assumption that or conclusion that there's a lot of dead stock in the market. There's a lot of lower quality goods that are difficult to move. So whereas the Rapspec A3 goods are in demand and moving, the Rapspec A3 and lower, or A4 and lower, are not moving as much. And so what that tells us is that there, and what we're seeing on the market, is that there's some erosion of the 4 C's as a price determinant. And the 4 C's being the cut shape, the carat size, the color, and the clarity, which was always sort of, the perception was that if you had the 4 C's, you could work out that helps you work out the price of the diamond. But there are many more parameters that go into the valuing of a polished diamond, and it seems that those factors have gained more importance over the last few years. So other factors such as the cut, polish, and symmetry, if it's a XXX good or not, XXX compared to VG or G goods, they sell at a premium, and that's been the truth for some time now. The issue of fluorescence. The issue of fluorescence is a diamond that has no fluorescence sells at a premium those with a diamond with no fluorescence sells at a premium to those with fluorescence. My apologies. Issues such as if the diamond is brown, green, or milky, BGM goods, etc. And so we see this. We did a search on RapNet just to illustrate the point of two diamonds with the same 4 C's and one factor that's not the same, and see the price difference. So we found a 2.5 carat J SI2 XXX none, no fluorescence, good, that's a diamond that has some medium milkiness in it, and we found that this diamond was selling at a discount to the wrap list of 50%, which came to a total dollar value of $8,785. And we found another diamond, which was pretty much the same, 2.5 carats J SI2 XXX none, but with no milkiness. And that diamond is selling at a discount of 30% to the wrap list, or a total dollar value of $12,250. And so that's a difference of 30% in the price of the diamond, and that's really the only thing that differentiates the two diamonds, is the milkiness of the stone. And so the market has become very specific in looking at the quality of the diamond that the buyer wants. And the same thing is playing out in the fluorescence debate. And I don't know how much our audience is aware of this, but we're going to look into the issue of fluorescence a bit deeper in the November Rapaport research report. So I'm working on that. I'm working on that now, and we're seeing that the gap between non-fluorescent and fluorescent goods has widened in the last year or two, and it's always been a bit of an anomaly for the trade. If you ask people in the trade, whether it's a grading lab or dealers themselves, they don't fully understand the issue of fluorescence, or why a non-fluorescent diamond sells at such a premium to a fluorescent diamond. And so we're going to be looking into some of those factors and why that is the case. But the point is that that demand has shifted more, or is increasingly shifting towards non-fluorescent diamonds. And today, this is an example from the tables that we're working on as a guide to fluorescent pricing. That's a 1 to 3 carat category of G to H goods on the VS goods, Faint is selling at a 9% discount to non-fluorescent, and 12% on the medium, and 15% on strong fluorescence. So it's a significant difference that needs to be taken into consideration. And so we start to understand that that RAP-spec A3, where we've seen a steeper decline in inventory and stronger pricing as well in the last month, that leaves a lot of excess other goods, lower quality goods left on the market. And so how do we deal with this, this so-called dead stock that's difficult to move and has been a weight on the industry's liquidity, really, in 2019. So in my discussions with Shimon, we came up with three scenarios that we feel need to happen or are happening, and we'll get to that, to help deal with this dead stock situation. So the first is that the miners would help the trade by taking those goods off the market, and we'll come back to these points. The second is that we engage in that the industry engages in targeted marketing of these goods. The industry's done that before. Rio Tinto, when it started producing a lot of sort of lower quality brownish goods from the Argyle mine, along with companies upstream such as Levian, created a new category of chocolate diamonds that they could use these sort of weirdish brownish lower quality goods from Argyle, and it became a category for the industry. And there's an opportunity there, I think, especially in the fluorescence, on the fluorescence issue, to create to increase demand through category marketing of these specific lesser desired goods. The third scenario is the one we least want, and that is to leave it to manufacturers to deal with, and that's really got us where we are today, with that overhang of stock that's weighed on the market in 2019. And so when we look at those first two scenarios, it's quite encouraging when that we have seen development in that sense in our news feed, at least, and in the market, of course, over the last few months. So the first, and both are from the mining side. The first is that De Beers in August, at the August site, allowed site holders to reject 50% of their goods on offer, and embarked on a more flexible, or implemented a more flexible supply policy. So whereas before site holders had to take a certain percentage of goods of the boxes that were on offer, De Beers allowed them to reject far more than usual without any perceived penalties at a later date. And what that allowed the manufacturers to do is cherry pick the goods that they need, and ease the amount, or lessen the amount of dead stock that they would ultimately have in their inventory. So De Beers has allowed that what we suggested in the previous slide, taking those lesser quality goods off the market. It's done so through its flexible supply policy, and that's continued through to this week's site. The second factor is that a few months ago, Reuters ran a story that Alrosa is talking to a number of jewelry retailers to market a jewelry brand that uses fluorescent diamonds. Alrosa has a higher proportion of, or has a high production of fluorescent goods, as far as I understand. And so it was looking at this issue of fluorescence and how it can increase the marketing and demand for that category that seems to be weak in the midstream at the moment. And so those are two very encouraging developments in the mining sector that gives us some hope for 2020. And so when we go back to our original question of what can we expect in the first quarter of next year, we take that into consideration. And so when we look at that question, again, we break it up into the supply side and the demand side. And in the supply side, what we want to see is that the mining companies continue with their strategies, that strategy of De Beers to limit, to enable flexibility in their supply, enabling site holders to take less goods. And from Alrosa's point of view, to really carry through with this marketing campaign that they're apparently embarking on. What I would like to see is the Diamond Producers Association get on board as well. The Diamond Producers Association being the sort of the industry marketing arm that's funded by the top 7 or 8 mining companies. But I would like to see them embark on a campaign for specific categories that need a lift. And I think there is an opportunity, again, for them to get involved in the fluorescence issue. We are seeing some encouraging signs from De Beers at the November site that's on the go at the moment in Gaborone. That De Beers has continued its flexible supply. As far as we understand, they have continued to allow site holders to reject more goods than normal, although I understand that it's a bit less than last month and in August as well. But more importantly, and this is a headline from our news feed today, that De Beers reduced its prices at the November site by about 5 to 7% across the board. And it's an interesting development because we have been calling for De Beers to reduce its prices for some time, and that call has met with mixed reactions. Many site holders were skeptical about it, saying that if you reduce prices, reduce rough prices, it's going to have a knock-on effect in the polished market, and therefore only add to the negative sentiment in the polished market. And so the question is, why is De Beers, the fact that De Beers is confident to reduce rough prices now maybe gives us some insight into how they see the polished market, that the polished market at this point has had some improvements, and those improvements are sustainable enough to withstand a reduction in rough prices. And it seems that is the case, and it's quite encouraging, and will ease help improve manufacturers' profitability in the months to come. So and I would expect, if people are buying rough now in November, the polished will come out around January, February, and come to the market. And if polished prices continue to rise, it will be a good boost of liquidity and profitability to the market, given that that polished would be sold based on a lower rough price. So that's a positive for the market. My one concern about coming from the mining side is that there is a feeling that that the mining companies are holding a lot of inventory of their own, that production this year has exceeded sales volume. And if we add that equation over the last 5 years, there has been some buildup of rough inventory across the major mining companies. This graph shows a combination of production and sales of those companies that publish both numbers, and that includes De Beers, Alrosa, Mountain Province, Petra Diamonds, Lucara, Firestone, and Gem Diamonds, and until now Stornoway Diamonds. If those were all one company and this was all their production, over the last 5 years, they would have built up around 14 million carats in excess, just by taking production minus sales volume. This year, De Beers has actually kept its production in line with its sales. And that's actually true of most of the mining companies. Alrosa, it being the exception, and Alrosa's production has exceeded its sales by about 4 million carats, and they account for most of that gap in the 2019 column. Alrosa reported that it has built up an inventory of about 21 million carats, and I think that is not a good thing for the industry, and so that could be sort of a vulnerability for the trade if the mining companies and particularly Alrosa pushes a lot of that excess rough to the market in 2020. I don't think the industry is quite ready for higher volumes. And having said that, the mining companies, we would expect them to reduce their production next year as well. They haven't published their production plans yet. So then shifting to the demand side, and we're looking at two markets. And at the beginning of the holiday season, when we say the holiday season, it's primarily the United States over Christmas, which it's generally considered November through December sales that we gauge the holiday season. And then also the Chinese market for the Chinese New Year, which this year takes place around I think it's the 25th of January. But looking at the United States, we see that the market is functioning, and it seems to be quite a healthy market from a retail point of view. But the point that is often being made about the United States is that it's changing. Retail is changing. And how is it changing? And the main change that we've spoken about before, since the 2008 recession, is that retailers are minimizing their inventory risk. They don't want to hold inventory, having learned the lesson in 2008, where consumer demand slumped, and they were left with a lot of goods that they couldn't move from their stores. But the inventory story is playing out in a different way as well today, in that we're seeing a lot of growth and emphasis on online and omni-channel platforms. When a company sells it, when a retailer sells a diamond online, they don't necessarily need to hold the physical inventory, as long as they've got access to it and can market the diamond online. That's an effective sales mechanism. So they don't need as much inventory as they did before. And similarly with their omni-channel being that interaction between online and in-store, that's not only with online feeding traffic to the physical store, but also the use of technology in the store to enhance the consumer buying experience. So I think increasingly we're going to see jewelry retailers using their iPads and using different technology in the store to show their inventory that's not necessarily physically on location, but that they have access to. And that's affecting the market. It's affecting their buying in the market. That the burden shifts to the dealer who's supplying them, and that's changed the way the dealers market themselves. You know, when we walk the trade shows, be it at the JCK Las Vegas show or the Hong Kong shows, wherever it is, many of the wholesalers, the diamond dealers, are not necessarily displaying their diamonds. They're displaying their technology, their innovation. They're trying to show what added value service they can provide the retailer and develop a relationship through that. And that's a very interesting development for me. Firstly, it's wonderful how the industry is embracing tech and innovation. But it also adds to that market segmentation that we spoke about before, because with the increase in online trading on a dealer level and also at the wholesale level, and also at the consumer level, sorry, you need to improve, you need to spur confidence in buying a diamond online. You need to give more information about that diamond. So there's a lot more transparency out there than we had 5 years ago. So whereas before the issue of the cut, polish and symmetry of the diamond wouldn't be of interest necessarily to a consumer, today they have access to that information. They see it online. Whereas before, the issue of fluorescence wouldn't necessarily have an impact on the same story. And with the imaging technology, for example, you can see exactly where the inclusions are, and so in a sense, it's kind of ironic, because without seeing the physical diamond, the buyer has access to more information about that diamond and its flaws. And so that has added to the market segmentation that's taken effect in the last few years. Also in the dealer market, we're seeing a lot, or how retail is affecting the dealer market, is that retailers are taking a lot more goods on memo, without necessarily buying the diamond until they've sold the diamond. And so the dealer needs to take on more of that inventory risk. And that's a trend that's been going on for a number of years and that we've spoken about in the past. Another trend we're seeing in the US market is that we've heard for a long time that bridal is soft, that the bridal market is not shown any growth. But really, it's argued by the trade now that it's being repositioned, and De Beers put out a wonderful report a week or two ago called their Diamond Insight Report, where they looked at the role that diamonds play in love and relationships. And it's not necessarily about bridal. The category has broadened because consumers today are not necessarily getting married or getting married later. Same-sex couples are wanting to express their commitment to each other and are very much engaged with diamonds to express that. People are cohabitating with each other before they get married. And within that cohabitation, there are life milestones that the diamond industry can take advantage of as a love gifting opportunity. And so De Beers and companies such as Tiffany & Co. and Signet Jewelers and others are not necessarily talking about bridal today, but they're talking about commitment diamonds, love and commitment diamonds as part of the whole category. And so that's something that the trade needs to feed into. And as De Beers, as Stephen Lucia, who we interviewed about the report, said, the industry can play the trade can play a role in educating retailers and helping position them in this development. So I thought it was very interesting and well worth a read. The other trend that we're looking at is that there's a strength in the luxury brands, and the major independents are also doing quite well. LVMH put in a bid to buy out Tiffany, and we see that as not only a vote of confidence in Tiffany, but also in the diamond jewelry sector. And I think we can afford ourselves that luxury to excuse the pun, but it really is a vote of confidence in the trade and specifically in that higher end sector, and the power of branding really. Tiffany being a very strong diamond jewelry brand. But having said that, Tiffany and other major chains, in particular Signet, which is the largest of the US jewelry retailers, are undergoing a transformation. They've embarked on strategies to cut costs and restore growth, and that will be on display in the holiday season. It will be a real test for both those companies, I think, and something that we're keeping an eye on. The other side of the picture is in China and Hong Kong, where there has been a lot of uncertainty, there's no doubt, as a result of the trade war, which has affected confidence and pricing in the local market. Hong Kong protests have impacted the luxury sector in the municipality, and as those protests continue, it continues to be an issue for jewelers. The municipality reported that their jewelry and watch sales fell by about over 40% in September compared to last year. And that's true across the individual, and we're seeing that in the results of the individual retailers as well. There are some encouraging signs that a trade deal will be reached, and that would definitely help restore some confidence in the market there. Looking at the impact on Chow Tai Fook, which we view as the largest of the jewelry retailers in Hong Kong for sure, in China. It reported that in the September quarter, its same-store sales fell 7% in China and 42% in Hong Kong. It was very much a gold story that as well, that gold prices were high during that period, and so consumers refrained from buying gold products. We see that the gem set jewelry sales, same-store sales, were flat for the period. In China, and the gold product in China was down 15%, and in Hong Kong, it was down. Gem set was down 35%, and gold products down nearly 50%. So it certainly is a reason for concern, and something that's gonna impact the market come the first quarter next year. When we think back to that story of those 30 pointers, one thing that did cross my mind is that the Chinese New Year, being in the 25th, I think it's the 25th of January, is a bit earlier this year, and maybe there is some buying in preparation for the Chinese New Year. But again, I'll reiterate what I said earlier, that we need to go back into the market and delve a bit deeper into the Chinese dealer demand that we currently seeing, and seeing if that's what's affecting the improvement in the 30 pointers. And so we'll stop here just to look again at what the results of the poll question, the poll was. And David, is there a way we can see the results? There we go. So what potential scenario do you believe will most affect the diamond market in 2020? It was a bit of an unfair question, because all those factors were really had a part to play in the weakness of 2019. And so, but it might be interesting to see what you had to say will continue next year. And so the top factor that 30% of you said would affect the market next year is that tight manufacturing liquidity due to the reduction of bank financing. Let me just put all the options up on the screen. So this bottom one was the most popular, 30%. 23% of you said continued excess supply. 23% of you also said that the slowdown in the US economy would have an impact on the market. 13% said that the unresolved US-China trade war, and the remaining 10% are more optimistic and expect the US economy to grow in 2020, which would have a ripple down effect on the diamond market. So let's hope that we can put our money with that 10%. So just my final thoughts before we take some questions. There's no doubt that the diamond industry is seeing an improvement in November. And that's as a result of reduced inventories, particularly on the RapSpec A3 better quality goods, as well as increased US demand ahead of the holiday season. To ensure that that sentiment continues into the first quarter of 2020, the mining companies must continue their strategies to reduce the excess dead inventory on the market. the industry must significantly increase its engagement with the right type of targeted marketing for the holiday season and beyond. And if that happens, and if confidence is restored in China, I have no doubt that 2020 will be a stronger year for the diamond trade, and I really do believe that it's attainable. So I want to thank you all for listening to me. I hope what I said made sense, and I'm happy to take questions, and I'm happy to engage in a discussion moving forward. So, David, do we have any? Do we have questions? And I can open them here, right? Mm-hmm. Okay. Okay. So our first question asks, is the demand side supposed to say 2018 for the first 4 sections? I'm not sure if I understand what that person is referring to. It's going to take a while. I think let me take another question in the meantime. I'm not sure what that's referring to, so I apologize. What are my thoughts on lab-grown diamonds and jewelry? I was hoping to be the first person in the diamond trade history not to mention synthetics in an hour-long presentation, but I've been caught out. I specifically didn't mention lab-grown because because it's a growing. There's no doubt it's a growing segment, but I don't think it's having an effect on the trade, and I don't think it's having an effect on diamond pricing at this stage. And so, what are my thoughts of lab-grown diamonds and jewelry? There was a wonderful panel discussion at a conference that was held in Dubai in late September, where they was really a debate between two producers and marketers of lab grown and two people on the natural diamond side. But the moderator presented 4 scenarios that may play out in the interaction between the lab-grown market and the natural market. And so questions such as are they competing products, or are they complementary products that can grow? If they're competing products, that one will eat into the market share of the other, or are they complementary products which the growth of one will spur the growth of the other, or are they two markets that will ultimately segment into completely independent markets? And I think that the two products will segment into separate markets ultimately, which is what the natural diamond guys we're banking on, and it's really there's the economics of it, where synthetic diamond prices, as supply increases, and the cost of production decreases, that prices will come down and be segmented from an economic point of view from the natural diamond, and also from a consumer attitude point of view. That there will be a realization that these are two separate and different products, both in terms of the messaging that they put out, and also in terms of their environmental impact and their scientific makeup. Stephen Lussier made a point that we know they are different because we have machines that within seconds can detect a diamond that's been grown in a lab. And so while the argument is that there is a a similarity in the carbon makeup of the two products, really they're different. And so I would agree with Stephen and the other panelists who were on his side of the debate, that the two markets will segment to different products. And the point that Stuart Brown, who's the CEO of Mountain Province, the mining company that owns Gacho Quay mine, made, is that at the moment we have a diamond market that is valued at $76 to $80 billion, and we need to figure out a way to grow the greater industry. How do we make that? How do we grow that 80 billion to 100 billion? And I think that's more of the important question for the diamond, for the natural diamond market, and as well for the lab-grown diamond market. It is a growing segment, but ultimately we expect, or I would expect them to segment into different markets. Hope that wasn't too much of a tangent. Kevin asks if these slides will be available to download. The slides won't, but we will be sending out a recording of the of this webinar to people who registered for it. So you should be able to review the slides through the video. We'll take another question. So this is an important question. Do you feel the Indian banks financing the diamond trade will maintain their confidence in the industry? It's an interesting choice of words there, Mark, who asked the question, because that's assuming that they have confidence in the industry. And I think one of the big changes that we saw in the last year or two that's influenced diamond prices, particularly for those lesser quality goods that are sitting in inventory, to decline, is that liquidity is tight because the Indian banks have cut back on their lending to the market. And that's as a result of I think a number of factors. There was a big banking fraud that Nirav Modi and Gitanjali carried out against one of the state-run banks, a $2 billion fraud. That doesn't add to confidence in the banking sector. The banking sector wants to see a transparent and profitable and honest industry, and so that's on the one side. That fraud case, I think, did affect the attitude of the banks towards the trade, towards the diamond and jewelry trade. And this the weak market, in that weak market where profitability has been slim and tight in the manufacturing sector, doesn't spur confidence amongst the banks. And so for the banks in India and in Europe and other markets to resume confidence in the trade, they want to see a better profitability in manufacturing, and they want to see greater compliance from a corporate mindset from the diamond companies, and greater transparency, and that's what they want. What they want to see. But it's a very sensitive relationship, I would say. What we are seeing is that the banks want the diamantaires to put more of their own equity into their diamond purchases. So they certainly are not financing a full box of rough. They want to see the manufacturers put in, be it 30 or 40% or 50% of their own finances to that purchase. And we'll take one final question. That Rutali asks, that the Knot put out a report this last week that 15% of bridal recipients preferred lab-grown diamonds. Wouldn't that soften demand for natural diamonds considerably for the coming months? I was surprised by that number. I don't think it's as high as that on in the bridal category, in any category, and the NOT survey is I think questioned very carefully. It's a proposal. Would you consider buying a lab-grown diamond for an engagement ring? And so the person, and it's not, have you bought a lab-grown diamond, and are you going to buy a lab-grown diamond? Would you consider it? So it is a wake-up call for the industry if 15% of those surveyed are saying that they would consider it. And that's really the challenge of that's really where that panel discussion in Dubai became interesting, because the guys on the lab-grown side, they were people who are branding lab-grown diamonds, and that's where they see their value. That it's not about the product that's giving the message of preciousness and value. It's the value comes from their branding and the message that the brand gives. And they certainly are tackling the bridal market. But if your question was for the coming months, I don't see a short-term effect. And personally, I think overall in the long term as well, there will, as I said earlier, that the inroads of the lab-grown market to the engagement ring market will be limited to the lab-grown product's ability to sustain its value. Okay, so I'm sorry I couldn't take everyone's questions, but we have run out of time. And if you email me, I'll try my best to answer any questions that other questions that you might have. Otherwise, we are looking forward to many developments at Rapaport. As I said, we're working on a new diamonds.net interface, and we'll be publishing the Rapaport research report in the next 2 weeks, where we'll be looking at that fluorescence issue. So thanks very much again, and I hope you enjoyed it and took something from today's discussion, and I'll see you again next time. Thank you.